Monopolistic competition. In monopolistic competition, there are a large number of firms selling the products and there are a large number of buyers. Barriers to entry are few and it's easy for firms to recoup their capital expenditure on exit from the market. Firms have some influence on the market price and therefore are price makers. Consumers face a wide choice of differentiated products. Each firm has a slightest degree of monopoly with the distinctive products. They enable firms to have mini monopolies. All firms have mini monopolies on its particular style of flavor or a brand name. For example, the fast food market. McDonald's has a distinctive style and flavor. Burger King has a distinctive style and flavor, and we can take example of pizzas also. Domino's and Pizza Hut, both of them have different styles and flavor. However, firms producing such products must also compete with other firms in the industry. Again, the example of fast food industry. The term monopolistic competition is a mix of mini monopoly and tough competition. So monopolistic competition is not same as perfect competition. It's somewhat different because each firm has its own form of monopoly while they face tough competition from others in the industry. The demand curve for monopolistic competition is downward facing. Its price elastic. Because there are other competitors in the market, they face competition from them. However, their own product is distinctive in their flavor and style. For example, there are a number of burger chains in the market. A lot of people are supplying burgers, all having their own distinct taste and flavor and style. So, there are a number of close substitutes available, but the flavor and style and sometimes price is what makes them distinct. This slide shows the difference between the demand curve for perfect competition, monopoly, and monopolistic competition. I would like to differentiate between monopoly and monopolistic competition here, but first let's see the demand curve for perfect competition. The demand curve for perfect competition is a straight line because the firm is a price taker. They can sell whatever number of product they want. They can sell whatever quantity of the product they want at the price that is dictated by the market. In monopoly and monopolistic competition, the firms are price makers because they set the prices. The demand curve for monopoly is relatively price inelastic because there are no close substitutes available and the consumer cannot easily switch to another firm to buy a similar product. That there is only one firm providing that product. These are shown as curves, but when we will draw the graphs will definitely be straight lines. Graph A shows short-term position of a firm operating in the monopolistic market. How do we determine the optimum output? We determine the optimum output where marginal revenue is equals to marginal cost. We extend this line to touch the average revenue curve, and the corresponding price is the price that this firm is charging. However, the price should have been down where this line touches the average cost curve, means this should have been the price. It indicates that there is supernormal profit present for firms operating in the monopolistic competition. The presence of supernormal profit can tempt other firms to enter the market, due to which the average revenue curve shifts left, as it can be seen here in graph B. It shifts towards left in the long run, thereby bringing the prices down. However, when the prices come down, what is the optimum output? Optimum output is where marginal revenue is equals to marginal cost. When we extend this line, this touches the average cost curve, but the price at which this firm is going to offer products in the long run will be above the lowest possible cost. It means that the firms operating in monopolistic competition are not allocatively efficient, not in the short run and not in the long run. For graph 1 means in the short run, average revenue is above average cost. In the long run, average revenue curve touches the average cost curve at 2 points, but the price at which this firm is offering products is above lowest possible average cost. Firms operating in monopolistic competition do not have incentive to produce their goods at the lowest possible cost because they are mini monopolies in their own, and they are able to charge higher prices or prices that they would like to charge. Some firms, they take advantage of their market position and brand loyalty to maintain the prices at which they want to offer their products. However, by spending on advertisement and promotion through which they build their brand loyalty, this spending may be temporary for some firms, and some firms may be able to take advantage of their brand positioning. It's not easy for rival firms to take away market share from any firm that has built their brand loyalty. However, the competition may become intense over time. In the presence of supernormal profits, when other firms enter the market, they enter the market to bring the prices down and bring normal profits in the long run. Firms, even in the monopolistic competition, will survive in the long run only with normal profits. Till the time that the market does not move to normal profits, firms will keep entering the market. But how is it that firms keep entering the market? They keep entering the market because barriers to entry are low in monopolistic competition. Also, if the firms want to leave market, it's easy for them even to leave the market. Another kind of imperfect market is an oligopoly. Oligopoly is a market structure where few firms dominate the market, and it's possibly the most realistic model of market structure. However, oligopolistic theory does not provide definite predictions regarding the price and output of the firm that exist in this model because the behavior of the firms is not very predictable. Following are the characteristics of an oligopoly. The market is dominated by a few firms. Firms are independent when it comes to decision making, and they decide their market strategies to compete with close rivals. However, all the firms operating in an oligopolistic market structure try to anticipate the behaviors and reactions of their rivals to think what their next step should be in the light of whatever steps their rivals take. Barriers to entry are substantial, which allows only a few firms to dominate the market. If it were easy for a lot of firms to enter this market, this would have become monopolistic competition or perfect competition. Therefore, there's a difference between barriers to entry between these two kinds of market structure. The products may or may not be differentiated. It depends upon the kind of product that the firms operating in this structure are offering. There is a possibility of price rigidity in this kind of market structure, which we are going to look at when we see the theories or the models through which this kind of market structure determines the output and the prices. There are two kinds of behaviors in this industry. Either the firms cooperate with each other, or the firms engage in aggressive competition with each other. Similar to monopolistic competition, firms operating in this kind of market structure are price makers. It means that they decide the prices themselves, and the forces of demand and supply do not determine the prices. However, one of the dangers of using this tactic of being the price maker is that the firm can be drawn into a price war. What does a price war mean? Price war means every firm in the oligopolistic market attempts to win the biggest market share, and in order to attain that share, they may engage in a price war by lowering their prices. If other firms follow suit, they will also lower the prices, and there will come a point where certain firms will not be able to further lower the prices and would be forced to exit the market. The nature of price wars may be defensive, where one of the oligopoly is losing market share to its rivals. However, situations where firms are highly diversified, they may be prepared to sacrifice profits by cutting their costs in an attempt to increase or even retain their existing market share. As stated earlier, that each firm in an oligopolistic market structure attempts to capture the biggest market share. The firms that are able to capture the biggest market share and derive profits from this kind of structure may use these profits to cover short-term losses elsewhere in the business. Now let's have a look at the Kinked demand curve, which can be used to study behavior of firms operating in an oligopolistic market structure. When we talk about oligopolies, there are two kinds of behaviors that the firms would demonstrate. Number one is either they will follow suit, means if one firm tries to lower the prices, others will also lower the prices, or they will not follow suit. The main motive of all the firms is to increase their market share and to capture the highest or the biggest market share. Also, there are two situations. One is price rigidity, where oligopolists do not want to change prices. And the second situation is slippery prices, where prices keep declining or prices keep reducing. The firms will demonstrate either of these behaviors in an attempt to retain or increase their market shares. Now let's have a look at the kinked demand curve. A kinked demand curve has two kinds of demands. First is the elastic demand, other is the inelastic demand. Top part of this curve is elastic demand. The lower part of the curve is inelastic demand. We know the features of elastic and inelastic demand. When the demand is elastic, a slight change in prices can change the quantity demanded. Inelastic demand is a bigger change in price does not have a bigger impact on the quantity demanded. Now that we have two kinds of demand curves, these are the average revenue curves. We will have two kinds of marginal revenue curves as well. Let's draw a line here. At this point, this is the optimum quantity that this market structure is providing. Let's name it Q. The corresponding price is the optimum price which this market has decided that this is the price at which they are going to provide goods and services. Now let's draw the marginal revenue curves. Marginal revenue curve is twice as steep, we know. This is first part of the marginal revenue curve. After certain discontinuation, there is the second part of marginal revenue curve. This point here is discontinuity in the marginal revenue curve. And this is called the kink in the curve. This discontinuity or kink is due to the kinked demand curve hypothesis, which states that firms will not follow suit when it's about increasing prices, whereas they will follow where the firms attempt to decrease prices in order to gain higher market share or to retain their existing market share. The kink or the discontinuity signifies that the market is not aware whether the firms will follow suit or they will not. So this is ambiguous or unknown behavior where the market does not know what is happening, whether others are following suit or they are not. Now, the portion of the elastic demand curve has rigid prices or sticky prices. This portion has slippery prices. Let's understand this using a few figures. For example, looking at the average revenue curve, this is the output of say 10,000 units, and the firms are offering this at a price of $500. If any firm tries to increase its prices to say this point, if the firm tries to increase their prices at 550, there's a drastic drop in the quantity, which is say 6,000. The output for this firm becomes 6,000. Hence, the revenue declines. If any firm tries to increase the quantity to say 11,000, which is probably here, let's assume 11,000 is here. If the quantity is increased to 11,000, there's a sharp decline in the prices to suppose 390. Sharp decline in the prices. The total revenue, if the firm is providing an output of 11,000 at 390, is equals to this, and if the firm is providing an output of 10,000 at 500 each, the total revenue is right. In case some firms increase prices, the revenue in both the cases of increased prices and decreased prices while quantity increase will decline as compared to the optimum quantity, which is 10,000 at $500. So in the top part, an oligopolistic has little incentive to increase prices because it will lose its market share to competitors and experience a substantial decline in the revenue. Whereas in the slippery price region, an oligopolistic is reluctant to lower its price because it may result in a price war in which all firms are forced to lower their prices. This in turn would adversely impact the marginal revenue, possibly resulting in losses. There may lie marginal cost curves in the kink region or the discontinuity region. It doesn't really matter if the marginal cost increases for the firm. It will not impact revenues in any way. Marginal cost 1, 2 and 3. As the marginal cost keeps increasing, the curve is shifting upwards. However, there will be a disruption in operations of the market if the marginal cost curve goes beyond this point. If the marginal cost curve lies here, then there will be an issue with the market functioning because marginal revenue is equals to marginal cost. So if we are to experience efficiencies in the oligopolistic market, marginal revenue is equals to marginal cost. Marginal cost curves have to lie in between this discontinuity to be able to intersect marginal revenue curves at the optimum output point. Talking about the kink demand curve, the point at which the kink exists has been chosen arbitrarily, means it has been chosen based on a personal whim rather than a system or a proof or a theory backing it. Existence of an arbitrary kink means that nobody knows where the kink should exist. Another criticism is that the kink demand curve does not depict how oligopolists will behave truly in an oligopolistic market. Also, it is not known whether the firm will choose price-related competition or non-price-related competition. Therefore, the kink demand curve does not truly depict how the oligopolist will behave. If firms choose to indulge into non-price-related competition, they would do so by spending more on advertising and promotion to build a strong brand. Also, they would focus more on product innovation in an attempt to make the products more appealing to customers. Another way in which the firm could focus on non-price related competition is through brand proliferation, where it may choose to produce a lot of products to saturate the market while leaving no gaps for the rivals. They may further choose to cater to the needs of a different market segment altogether or move towards process innovation to bring down their costs, thereby enabling themselves to bring down the prices without sacrificing profits. These are some of the strategies an oligopolist may choose to engage into non-price related competition. However, choosing competitive strategies and predicting behavior or response of the rivals in an oligopolistic setting is difficult. Given such a situation, the objectives of the firm operating in an oligopolistic market structure may change over time because of the uncertainty and unpredictability of the behavior of the rival firms. They may switch from profit maximization to survival or any other kind of objective in the long run. We are going to study the range of objectives of the firm later on in this chapter. Oligopoly can also be studied using prisoner's dilemma. Prisoner's dilemma in actual is a situation where two otherwise rational people might not cooperate. Let's take example of two criminals. Two criminals are jailed and they have no way of contacting each other. They are in separate rooms. There are two situations. If they both cooperate, they will either both stay silent or they will both betray each other. Both stay silent is this outcome. Both betray each other is this outcome. One stays silent and the other betrays. If one of them betrays, one goes free while the other has to serve in jail. If we look at the outcomes, which one is the best outcome where both the parties are better off? When both of them stay silent. This is the best outcome that they can get, where both of them have to serve only 1 year. If they choose not to cooperate, one is going to serve 3 years, and if they both choose to betray each other, both of them are going to serve 2 years, which is a total of 4 years. Here this is a total of 2 years, here 3 years, and here it's a total of 4 years. So if they both can find a way to cooperate with each other, both the criminals will be better off. This is the prisoner's dilemma. Now let's observe the oligopolistic version of prisoner's dilemma. This is the oligopolistic version of a prisoner's dilemma. There are two options. Either both the firms hold down the output, or one firm increases the output while the other does not, or both of them increase the output. If A thinks B are going to cheat on them, A will also betray, means both of them will increase output, while each firm gets 400 and a total of $800. If both of them can find a way to cooperate with each other, both the firms will get 1,000 each, which means a total of 2,000. In a situation where A does not betray and keeps their promise while they do not increase the output, and B betrays them, there's a total of 1,700. And here also there's a total of 1,700. This though is the best outcome, where both the firms they hold the output and do not try to increase it. This is not the situation in oligopoly. Firm A will have reason that it makes sense to expand the output if B holds down the output. A would know that they can earn additional revenue or capture additional market share if B is not increasing their output. It also makes sense to expand output if B raises the output, because they would want to be in the war with B and capture the market share. B also faces a parallel sets of decisions. The result of this prisoner's dilemma is often that even though A and B could make the highest combined profits by cooperating in producing a lower level of output and acting like a monopolist, the two firms may well end up in a situation where they each increase output and earn only 400 each in profits. What do oligopolists do when they are faced by prisoner's dilemma? There may be situations where large firms find that it's in their best interest to cooperate with their rivals. One of the best examples of such a situation is where research and development costs are high proportion of the total cost and where technological change is extremely rapid. It is then in the best interest of the firms to share their knowledge and agree on technical standards, perhaps taking part in joint ventures. A real life example of such a situation is producing a vaccine to combat COVID 19. Another strategy that they may adopt is collusion, which is the opposite of cooperation. Cooperation is allowed in markets, whereas collusion is not allowed. There are formal and informal kinds of collusion. Collusion is a secret cooperation or deceitful agreement in order to deceive others. It's an anti-competitive action by producers. Informal collusion, however, is not illegal and usually takes the form of a price leadership, where firms automatically follow the lead of one of the group. The objective is to maximize the profit of the whole group by acting as a single seller. The price leader is invariably the dominant firm and has sufficient market power to determine a price change that other firms will follow. Collusions are more likely to be informal because there is no written agreement. One way of doing that is when firms follow the actions of the dominant firm and the motive is to act in the best interest of the entire group. If all the firms follow suit when the dominant firm decreases prices, then they will have sufficient market power. They will be able to exert sufficient market power over the suppliers as well as the buyers. However, there is difficulty to identify either formal or informal agreement because the price similarities may be a result of either aggressive pricing in a competitive oligopoly or the outcome of a collusive agreement. Nobody can determine it with certainty which kind of agreement is present in an oligopoly. Third strategy is a cartel, which is a formal price of output agreement between firms in an industry to restrict competition. Cartels are illegal. By joining a cartel and agreeing prices, firms are operating as a single seller and maximizing their profit. Output levels can regularly be agreed upon by the cartel. An incentive for one producer in a cartel will always be to increase their own supply, taking revenue away from other members of a cartel. In a simplified way, it shows how prisoner's dilemma can result in a breakup of the cartel, which could make the wider community better off through cheaper supplies. In cartels, one party would be motivated to increase their output and revenue if others agree to hold the output and not increase their output. Monopoly. Monopoly is where a single firm controls entire output of the industry, and it is a word that can be used to describe a situation where one firm has a very large share of the market. Monopolies are at the opposite spectrum of competition, means in competition there are many seller in perfect competition, whereas in monopoly there is only one seller. In case where there is only one buyer, that's monopsony. In theory, monopoly has following characteristics: single seller, no close substitutes, high barriers to entry, everybody cannot enter, and the barriers to entry are high. In such a situation, no firms will be able to enter the market to capture their share of supernormal profits existing in the monopoly, which we are going to have a look at in a while in the graph. And the monopolist is a price maker. Which other firm is a price maker? Oligopolist is a price maker, and somebody operating in a monopolistic competition is also a price maker. The only price taker firm we have is the one operating in perfect competition. When we hear the word monopoly, what comes to our mind is one gigantic firm, which is not the case. Monopolies do not need to always be gigantic. There can be a local monopoly as well, and that firm which is locally monopolist can be a relatively small firm which dominates the market, either because it's too costly for others to enter the market, or the profits in that market are not very high. It is perceived that monopolies cannot be broken and they have immense power over the market, but that's not the case. The power of monopoly is sometimes over exaggerated and overestimated, because sometimes even a domestic monopoly can be suddenly broken up by new competition. That competition can be from an overseas importer of similar goods and services. For example, this kind of a firm that's a monopoly faces a downward sloping market curve as discussed earlier, but this demand curve is relatively price inelastic because there are no close substitutes available. However, a monopolist may not be always able to charge supernormal profit despite having immense power. One such example would be where fixed costs are so high that if they tried to charge a price at which they are able to make supernormal profits, it would be outside of the range of the consumers and it would not be affordable for them. In such a case, they would want to charge a normal profit and hope that the revenues are sufficient to cover production costs. They would be happy making normal profits. Now let's have a look at the graph of the monopoly. First thing that we need to observe is average revenue is greater than average total cost, which means that there is presence of supernormal profit. We can already see that. Now, where is the optimum output? Where marginal revenue is equals to marginal cost. We extend this line to see what is the price that this monopolist is charging, and we can see that this is the price that the monopolist is charging. This price is well above the cost, which is where the extension of this line is touching the cost curve, which is here. This is the cost. The monopolist could have sold this for this price also, where they would be making normal profits. However, we can see that there is presence of supernormal profit for this firm. However, this firm is not allocatively efficient, not producing at the lowest cost, but it is producing at a cost above its lowest cost. Monopolists do not have incentives to produce at the lowest possible cost because they are going to charge a price way above their cost anyway. It is less likely that the prices in a monopoly will come down because there is no other firm that will enter the market. Prices come down only when other firms enter the market, which shifts the supply towards right. Increase in supply brings the prices down, whereas in this situation there is no increase in supply due to high barriers to entry. Other firms will be unable to enter the market, thereby enabling the monopolist to retain supernormal profits in the long run. Monopolists do not try to reduce their profits to normal profits until and unless there is a situation where the price becomes unaffordable for the consumer. A monopolist may also try to maximize their profits by adopting the price discrimination strategy, where they split the output, sell some output to one market at a different price and to other market at a different price. This way, they maximize their profits. One kind of monopoly is a natural monopoly, and it's a situation where a monopolist has overwhelming cost advantage and has sole ownership of resources, or where past ownership of capital resources means that it's difficult and extremely expensive for competitors to duplicate these factors of production. Doing so would be extremely wasteful. One such example is railways. There's no incentive for anybody to start a railway service other than the existing railways. The infrastructure cost is so high that organizations or firms cannot bear such a huge cost. Now, let's have a look at the natural monopoly graph. A natural monopoly occurs when the most efficient number of firms in the industry is 1. A natural monopoly will typically have high fixed costs and low marginal cost as described earlier, meaning that it might be inefficient to have many firms each providing the same product. Long run average cost continues to fall over a big range of output. The shape of the long run average cost curve for a natural monopoly can mean that it is tough for smaller challenger firms to enter the market profitably. The figure shows a falling long run average cost curve, and we can see that economies of scale occur at this average cost curve. Average fixed cost will also decline, offering the prospects of substantial benefits to be gained from economies of scale. If we can see, this is a cost curve where this firm experiences economies of scale. These are the long run costs. Where is the efficient output? Where marginal revenue is equals to marginal costs. If we extend this line, we see what price this firm is charging. This is the price because this is the point where this line, when extended, touches the average revenue curve. A monopoly firm would set prices at P while earning supernormal profit
at output Q.
However, government provides subsidies to this natural monopoly so that costs can be brought down. As there is no one else providing the similar goods or services,
This subsidy helps natural monopoly behave like perfect competition and to provide at equilibrium prices where marginal revenue is equals to marginal cost.
if the monopoly behave like a competitive firm, equilibrium position will be where price equals long run marginal cost, where P1 would be the price and Q1 would be the quantity because long run marginal cost. This is a loss making position for the firm. The problem is that this will only happen if the government is prepared to subsidize the monopoly on the grounds that what it is providing is an essential public service. This is the subsidy that this firm receives in order to be able to provide at this price level. If the firm provides at this price level, obviously it's making a loss. For this firm to be on a normal profit level, it should have this level as the price, and the revenues generated would be sufficient to provide Q1 quantity. Why does the government do this? The government does that because this service is essential. Railway, for example, and if the government forces this natural monopoly to lower their prices, this monopoly can cater to the needs of more people and can provide more quantity of this service at a price which is affordable for people. Though this price is below the cost that this natural monopoly incurs, but this firm does not suffer a loss. This is making a normal profit. However, the government takes away all supernormal profit from this kind of monopoly. The graph shows a comparison between monopoly and perfect competition, and this both of them are observed on the same graph. Let's observe it first for the monopolist. Efficient, allocatively efficient output occurs at marginal revenue is equals to marginal cost. This is going to be the output that we are going to use for both the kinds of markets. monopoly as well as perfect competition. For a monopoly, when this price is extended to touch the average revenue curve, it will touch here. So this is the price for a monopoly, as this is the average revenue curve for a monopoly. This curve is not for perfect competition. The curve for perfect competition is this, where demand is equals to marginal revenue is equals to average revenue is equals to marginal cost is equals to average cost. So marginal revenue is equals to marginal cost. Perfect competition will be providing goods and services at a lower cost and is also providing more quantity. There is presence of supernormal profits in the monopoly, whereas there is no presence of supernormal profit in perfect equilibrium. We can see that the cost for a monopoly is this, because this is the point where when this line extended touches the cost curve. This is not efficient because this point does not lie on the least cost point of the average total cost curve. It can be seen that if the monopolist is providing this quantity at this price, and in perfect competition, this is the revenue, this is the total revenue here, we are experiencing a dead weight loss. Why we are experiencing a dead weight loss? Let's have a look. For perfect competition, this is the consumer surplus and this is the producer surplus. But when we look at the monopoly, for monopoly, this is the consumer surplus. This becomes the dead weight loss. First part of dead weight loss. Why? Because this part is the supernormal profit. This is the producer surplus. This box is the producer surplus in monopoly. So this part becomes the dead weight loss as well. That is why this triangle is the dead weight loss. I wanted to explain how we found out that this part is the dead weight loss. There are certain observations that we can make using this comparison graph, that the price of monopoly is higher than the price of perfect competition. Secondly, output of monopoly is lower than perfect competition. The monopolist is making short run and long run supernormal profit, whereas the firm operating in perfect competition is only making normal profits. The firm in perfect competition is productively efficient because marginal revenue is equals to marginal cost. This is the output that it's generating. However, the firm operating in monopoly is not productively or allocatively efficient. Monopolist captures consumer surplus and converts it into supernormal profit. They are also charging well above marginal costs, so they are not allocatively efficient as well. If a perfectly competitive industry was turned into a monopoly, there would be a welfare loss of area X, as shown in the figure, in addition to greater allocative inefficiency. Why greater allocative inefficiencies? Because monopolies do not produce at the lowest possible costs. However, there is criticism of monopolies being compared with perfect competition. Why? Because in real world, monopolies based on comparison with perfect competition may not be valid. There are two reasons. First, perfect competition is a theoretical ideal model. To have more relevance, Monopoly must be compared with more real-life models of monopolistic competition or oligopoly, as these models are characterized by productive and allocative inefficiencies. These models may also involve a waste of resources in competitive advertising. The second reason is this figure that is shown here is drawn on the assumption that the costs in monopoly will be the same as perfect competition, and this aspect ignores the possibility that the monopolists can achieve internal economies of scale, which would reduce unit costs. It is therefore possible that a monopolist could charge a lower price than would occur in perfect competition, which would make consumers better off, even though the monopolist is making a supernormal profit. Also, there do exist inefficiencies when equilibrium positions of monopoly and perfect competition are compared. The inefficiencies are less consumer surplus, which monopolists take and converts into supernormal profit. Producer surplus in monopoly is greater than in perfect competition because a monopolist is charging a higher price, and the deadweight loss is the sum of loss of total consumer surplus and producer surplus, as I had explained. There are, however, positive aspects of a monopoly creation as well. A monopolist cannot always make a supernormal profit, for example, in situations where fixed costs are extremely high. Secondly, the concept of supernormal profits must be considered carefully. One of the criticisms of a competitive market is the uncertainty of profits in the long run. However, a monopolist can plan future investment and finance it through what are guaranteed profits, which may offer customers better products and greater job security. The investment may take form of innovation, ultimately lowering the costs. Also, the profits can be invested to attain X efficiencies, and monopolies reap benefits of economies of scales.